The Russell 2000 would be the index that best captures the domestic economy. And that was the index that was the weakest. So again, to me, this is more about multinationals and about stronger economies overseas than it is about a strong U.S. economy, because if it really was about a strong U.S. economy, then maybe those stocks that are most connected with just the U.S. economy would have been the biggest gainers. Instead, you had the biggest gainers in the bigger multinational companies that derive their earnings globally rather than concentrated in the U.S. And in fact, the narrative that continues to circulate on Wall Street is one of a stronger U.S. economy that is stronger than had been forecast, forcing the Fed to adjust policy and to start increasing interest rates sooner than the Fed currently expects. That's the narrative that's out there. But you have to realize that this is a false narrative. Yes, we're getting some strong numbers. And in fact, we got more stronger economic numbers that came out today that I'm sure will reinforce this narrative. We got the PMI composite index that was released. This is for the month of March, and the level was supposed to drop somewhat from the February number of 59.5. The consensus was for a drop to 59.1. Instead, we ended up rising to 59.7. So not only did we beat the consensus, but we increased on the prior month rather than the decline that was being expected. And in the service index, that was supposed to expand from 59.8 to 60. It did expand, but it expanded to 60.4, so a stronger expansion than had been expected. So people are traveling that weren't traveling before. They're eating in restaurants, they're going to bars, they're doing all sorts of things that they temporarily stopped doing. And so now that they're able to do that, well, sure, the service index is spiking. But you have to also bear in mind that one of the main reasons that it's coming back as strong as it is because of all the cash that is now burning holes in the pockets of Americans. But where did that cash come from? It came from the U.S. government. It was printed into existence by the Federal Reserve. It is the stimulus that is propping up the consumption and the spending. And of course, a lot of these service sector jobs rely on a lot of goods that have to be imported in order for the services to be provided. And this, of course, is helping to fuel our record high trade deficits. But this is not legitimate economic growth. Also, I still believe that there are a number of Americans who are not paying their rent, who are not paying their mortgages, who are not paying their student loans, right? Because there's still moratoriums on all those. And so that's also freeing up a lot of cash that can now be used to, consume services that prior to that was being used in rent payments or student loan payments. Now consumers have a lot of extra cash, but in theory, at some point, they got to start paying their rent. In fact, they got to start paying the rent that they missed. I mean, it's not a free rent. It's just that, you can't get kicked out, but ultimately you still owe the rent that you didn't pay. But a lot of this spending is basically borrowed from the future, and a lot of it is purely a function of the Fed and the stimulus. And that's why I think the forecasters are wrong in thinking that this strong economy is going to cause the Fed to raise rates sooner. And in fact, even if you look again at the bond market, the spread is continuing to narrow between the 10s and the 30s. We had yields on the 10-year Treasury up 0.41 basis points today at 1.72, but the yield on the 30-year only rose by 0.23 basis points to 2.363. So again, what this is showing me is that bond investors are not really worried about inflation. If they were worried about inflation, the yield curve would be widening. They would be more concerned about a 30-year Treasury than they are about a 10-year Treasury. What the bond market is pricing in is higher interest rates to successfully fight off inflation. And so investors don't believe that the higher rates will be as big a problem for a 30-year bond as for a 10-year bond, because the 10-year window would include the higher rates over the next few years necessary to fight off that inflation. But the 30-year rate would probably start to factor in the next round of rate cuts after the Fed pushes the economy maybe into recession at some point to successfully fend off inflation. But this is not going to happen because we don't really have a strong economy.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
We have a lot of spending, but it's not the result of economic strength. It's the result of money printing. In other words, inflation. Inflation is what is powering the entire economy. How is the Fed going to fight inflation when inflation is the only thing the economy's got going for it? It's the only thing the market's got going for it. It's the only support to the economy and the market. It's the only thing that keeps the government spending. Inflation is the only reason that we can have an infrastructure bill, because inflation is what's financing it, meaning the expansion of the money supply, the printing of money. So there is no way the Fed is going to sever the only lifeline that the economy and the markets have. So the markets have it wrong. The Fed is going to ignore an inflation threat that's actually greater than is generally perceived. They're going to do nothing about it, and interest rates are going to stay low. Real interest rates are going to continue to get more and more negative, and eventually this story is going to unravel. Meantime, based on this belief, you're getting pressure on gold, which did not really rise today. It was relatively flat. Gold was down less than $2, about 17.28, 29 an ounce is where we closed. Silver was off about 7 cents on the day, 24.84. Again, this is all the narrative that the Fed is going to be raising rates due to a stronger economy. Meanwhile, the dollar did not respond today to that narrative. The dollar index was actually down 0.4. So a pretty weak day across the board for the US dollar. And even though gold was down a bit, gold stocks were generally higher to unchanged on the day. So they didn't go down. A few of them managed to go up. You know, there was a positive report or article over the weekend in Barron's about Barrick Gold. So that's one of the few positive stories that I've seen. But again, most of the stories I've read are about why you don't want to own gold, because rising interest rates are bad for gold, because a strengthening dollar are bad for gold. But of course, the dollar isn't going to strengthen. The dollar is actually going to fall off to new lows. They're also saying that the strong dollar is going to be a negative for emerging markets and commodities. People expect a more aggressive Fed and a stronger dollar to weigh on commodity prices, but they're wrong. We're not going to have a more aggressive Fed. We're going to have an easier Fed, and all that is going to help support even higher commodity prices, and it's going to be very supportive of emerging markets. Again, the Fed can't fight inflation. The Fed is deliberately creating inflation because that's the only reason that everything isn't collapsing. So the Fed is not going to stop creating inflation. In fact, it's going to create even more. And as I said on a prior podcast, I think the next recession is actually going to be caused by inflation. It's going to be rising prices that cause consumers to cut back on what they're buying. I mean, they may be spending more, but they're going to be buying less because the stuff they need to buy is going to cost more money. So they're not going to buy as much stuff. And that means a lot of the companies that used to sell that stuff, they're going to have to cut back. They're actually going to start laying off workers because they're not selling as much stuff and because their costs are going up. Not only all their raw material costs and other costs, but their labor costs are going to be going up. And look at insurance costs. I mean, a lot of people aren't talking about this, but that storm in Texas where the power was out for, a week or two, it was cold, a lot of these pipes froze, a lot of structures flooded. There is tremendous damage throughout the state of Texas. And this is also going to hurt a lot of these insurance companies because when there's a hurricane, usually people have much higher deductibles. So the insurance companies aren't exposed as much. But here it wasn't a hurricane. It was just ice that caused these pipes to burst. So all the normal deductibles are going to end up applying. So this is going to be horrific claims. So look, prices are going to be going up across the board for everything. And I think that's what's going to push the economy into recession. And of course, how is the Fed going to respond to increasing inflation that pushes the economy into recession? Are they going to fight the inflation and push the economy into a deeper recession? Or are they going to ignore the inflation and create more of it in order to stimulate the economy either out of recession or to try to prevent it from entering one? Obviously, it's going to do the latter, and when the markets figure that out, gold's going to take off and the dollar's going to get clobbered.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.